Dogecoin can now be purchased on a decentralized exchange after a successful listing by THORChain and a long wait by market participants DEX. In a recent announcement, the cross-chain liquidity network THORChain announced that it has enabled support for Dogecoin, opening the door to decentralized finance capabilities for the token. Thanks for watching Crypto Lion. If you haven't already, consider hitting that subscribe button and turning on post notifications. We also have a crypto Discord group where we give out calls for our favorite altcoins, and you can also win special rewards for inviting your friends to the group. Links for that are in the description. THORChain's support is expected to provide the first ever DeFi protocol connection to the meme token blockchain network, allowing users to exchange Doge for Bitcoin, ERC20 tokens, BSC tokens, LTC native tokens, and stablecoins. The integration allows users to enter and exit the market without having to comply with Know Your Customer regulations, giving the asset more sovereignty. Furthermore, a liquidity pool established for Doge allows the asset's liquidity providers to earn yields on their deposits from trading fees. Depositors, like other liquidity providers on THORChain, have impermanent loss protection based on the period of time that each deposit is held. Also, the non-custodial offering is expected to open up new yield farming opportunities for larger investors seeking higher yields from their stacks via a new Doge liquidity pool. Furthermore, Doge's DeFi venture is expected to improve the meme coin's narrative as a store of value and as a medium of exchange. Dogecoin has long been a bystander to DeFi growth, but this integration places the blockchain at the forefront of the DeFi ecosystem, promoting overall growth. However, market developments such as Tesla accepting Dogecoin for merchandise have largely failed to push spot prices in the right direction over the last month. Elon Musk, the CEO of Tesla, has endorsed Dogecoin over Ethereum, claiming that Doge can be used to make decentralized finance more accessible for everyone. The DeFi system is a blockchain-based form of finance that does not offer services through financial intermediaries such as brokerages, exchanges, or banks. Users can keep custody of their Ethereum-based crypto assets on such platforms. Musk was responding on Twitter to a CoinDesk story about how the Ethereum-based DeFi protocol is becoming inaccessible to small vendors due to high transaction fees. Musk responded to the story with a one-word response, Doge, referring to his favorite cryptocurrency. According to data from crypto metrics site BitInfo the average transaction fee, or gas fee on Ethereum, is around $51.45, while Dogecoin's gas fee remains relatively low, hovering around 65 cents per transaction. This is one of the reasons Musk has continued to refer to Dogecoin as the people's crypto. A staunch supporter of cryptocurrency, he also wants crypto holders to keep their keys and not rely on cryptocurrency exchanges like Robinhood or Binance. Musk's frequent digital tweets have contributed to the digital token's craze. Musk's Twitter bio was once changed to former CEO of Dogecoin. According to CoinMarketCap, Doge is the 10th largest cryptocurrency at the time of recording this video, with a market cap of over $19 billion. Former CEO of Twitter, Jack Dorsey, announced some weeks ago that Square, the financial company he also runs, will launch a new platform for creating decentralized finance projects using Bitcoin. In the midst of the usual constant online noise surrounding cryptocurrency, Square's project may be remembered as a watershed moment, the moment decentralized finance, or DeFi, entered the mainstream. DeFi has emerged as one of the most significant developments reshaping the cryptocurrency world in recent years. Rather than Bitcoin, its rise has been closely linked to the rise of Ethereum, the world's second cryptocurrency, whose decentralized network, or blockchain, enables the provision of services and the execution of more complex tasks than simply sending and receiving payments. It all began, arguably short after the 2017 ICO bubble, when thousands of entrepreneurs and gamblers raised billions by selling cryptocurrency tokens online as if they were stocks in often non-existent companies. Following the crash, Ethereum began to crawl with a slew of services, dApps or decentralized applications, offering a diverse range of financial operations from loans to futures, exchanges, and algorithmic trading. Disintermediation was the selling point, as it is with most cryptocurrency projects. Users of these services would be freeing themselves not only from traditional financial intermediaries, but also from cryptocurrency-focused institutions that have evolved into gatekeepers, such as corporate cryptocurrency exchanges Bitfinex and Coinbase, as well as Tether, the company behind the stablecoin USDT, a digital asset whose price is theoretically pegged to the dollar. Users of Ethereum's decentralized financial apps are able to trade without having to go through the identity checks, anti-money laundering regulations, and other limitations associated with centralized alternatives. It was also a lot more enjoyable. The advantages of DeFi are numerous. Number one, it should be up 100% of the time, right? Because Ethereum is always up, DeFi is always up, explains Lex Sokolin, co-head of decentralized protocols at blockchain software company Consensus. Then there's composability, which is the ability to layer. That is, different applications on the blockchain can be programmed to work in sequence, one after the other, in a single transaction. Their individual operations arrayed and stacked together like Lego blocks. In a matter of seconds, a program could automatically borrow cryptocurrency from a lending platform, dump it on a decentralized exchange in the hope of causing its price to plummet, buy it back, and return it, possibly pocketing a small margin. Investing strategies are transformed into puzzles, jigsaws of software commands that must be assembled on the fly. You can build the portfolio, and once you have the portfolio, you can build the margin. And once you have the margin, you can build the interest. And once you have the interest, you can build an aggregator of fixed income, and then tokens, and so on, Sokolin says. This accelerates everything, and it makes it go really, really fast. I'd say 50 to 100 times faster than if it hadn't been built on DeFi. That's exciting, but not without its complications. People are making some really interesting but mostly experimental tools. These are most likely built by amateurs who have no idea how actual finance works, says Emin Günserir, an associate professor of computer science at Cornell University and the founder of cryptocurrency firm Ava Labs. Some of these Lego building blocks are quite interesting and they can do things that Wall Street cannot. However, some of them end up interacting in unexpected ways. The flash loan incident, which sent shockwaves to the crypto world on St. Valentine's Day in 2020, was one of the first and most infamous manifestations of this unpredictability. On that day, an anonymous trader profited $350,000 in Ether from lending platform BZX by deliberately pumping asset prices on the exchange BZX relied on for pricing data. The best part, the funds were obtained from a platform that allowed users to obtain cryptocurrency loans for a very short period of time, hence the term flash loan, without providing collateral. The trader had turned nothing into a lot of money. The chaos and panic surrounding the global pandemic, combined with several regulatory crackdowns on centralized cryptocurrency exchanges, only increased the popularity of DeFi protocols, such as MakerDAO, Uniswap, and Compound among the cryptorati and aspiring investors in the months that followed. By late 2020, yield farming had become the hottest thing in DeFi, a mechanism for earning new cryptocurrency tokens simply by depositing other tokens on decentralized lending markets. That lent itself to the usual crypto-adjacent zaniness, projects that were hyped to the moon and then crashed, memes and food emojis that were traded like precious assets, long before the GameStop craze and Elon Musk's romance with Dogecoin, and of course, the occasional scam. The ICO frenzy was over, but the scramble to get the latest governance tokens and a piece of this or that DeFi protocol was eerily similar to 2017. Even if research suggests that the people involved in this new gold rush are more financially literate than the poor saps who lost their shirts in the ICO frenzy. DeFi protocols were supported by approximately $1 billion in cryptocurrencies in December 2019. By August 2020, that figure had risen to close to $5 billion in Ether and Bitcoin. Today, the value of locked Ether has risen to more than $55 billion. Nobody knows where this will lead. According to Carl Flourish, a researcher at the Ethereum Foundation, there's a risk that a cascading failure will simply end it all. For example, he claims that DAI, a stablecoin issued by decentralized organization MakerDAO that is roughly pegged to the dollar via cryptocurrency collaterals, is one of the main assets underpinning the DeFi ecosystem. The next big question in crypto is whether Ethereum will maintain its position as the go-to DeFi ecosystem, or whether that will change, possibly as a result of projects like the one Dorsey announced. Without a doubt, as cryptocurrency becomes more institutionalized, DeFi remains one of the last bastions of crypto's early decentralized yen. And paradoxically, the big players are still concerned about it. That's it for today, folks. Thank you for watching today's video. If you enjoyed it, make sure you subscribe if you haven't already, and turn on bell notifications. If you have any questions, drop us a comment, and as always, good luck and happy investing.
That's how it goes. Hollywood Carson.